The global economic collapse is looming in the distance. Precisely when the worst effects will be felt is unknown, but 2018 has turned out to be a terrible year, and 2019 is expected to continue that sentiment until the pending issues related to trade have been resolved and the Fed ensures an abundance of liquidity for the desperate markets. 2019 is going to be a very dangerous year to be in debt or those playing with margin. You came here for the truth, so let me unveil that for you. Today we're going to look at several issues related to 2019. I want to talk about when the money stops flowing. I have some articles and charts to show you here, and I wanted to begin by taking a look back in the pages of history. Wall Street's 2018 S&P 500 targets, so just before 2018, these companies were asked during these surveys, where do you think that the prices will be at the end of 2018? 3,000 seems to be the average here. And this could be a miracle, but it doesn't look like it. It doesn't look like the major corporations will be able to get the targets that they thought would happen. And that's because, of course, of 2017 being an extremely good year for stocks. 13 months in a row. It went all the way through 2017 and more with incredible gains, month after month after month. And so we see that things have really changed here. From October into November and now December, the markets have looked very weak for 2.5 months. And so that brings me to the point that I want to get into in this video, beginning with my favorite chart, and that is central bank assets declining over the last few months. You could see this here, particularly being an issue when you look at the equities around the world. Emerging markets were hit early on this year, but even the US stocks since October have really fallen. And you can look at the global bank stocks, European companies, European bank stocks, emerging markets in general, just not doing good. So the blue line are the central bank assets. This is updated information. The red line is the MSCI World excluding the US, and the green line is the NASDAQ. So the NASDAQ has been up and down, that's for sure, but it's looked very weak from its peak. And you're seeing a lot of these different indexes into a bear market today. The bear market is continuing. It's a cycle and it is a self-fulfilling prophecy. This is beginning to happen at the same time when you have piled on the trade issues that are ongoing, that even though we should have had some level of resolution by now, it seems like nothing has been permanent, nothing has been set in stone. And of course, as long as the environment is uncertain, you're going to have problems with equities. You can see the orange line here, the global systemically important banks getting beaten down to a level that is entirely unstable. We're talking about the biggest banks in the world, and we are far beyond a bear market. According to this chart here, as I've covered recently, the global systemically important banks on their index was approximately 155. Today it's sitting at 103. So from 155 to 103. This is severely into a bear market. The world is unprepared for the crisis that will ensue. And it's the central banks that are deciding when these fall. If you don't see the correlation in between the markets today and the central bank assets, quite frankly, I think that you are purposely and intentionally keeping yourself from the truth. This is the most telling chart, and if I can bring this up twice a day, every day, in all the videos I do, then I will. That's how important it is. So I wanted to cover some other information here. Looking at the big balance sheets, advanced economies brought securities to stoke their economies. At the top, you're seeing the Bank of Japan. In the middle, that's the Federal Reserve. And at the bottom, it's the ECB. And you could see how their balance sheets have been modified over the years. This chart goes back from basically the year 2000 up until present. Now, right now, what we are seeing is actually central banks. They are just about to go into the negative for the amount of money that they're printing overall. Because of course the Federal Reserve themselves doesn't need to print money. You could have that coming from the ECB or the BOJ, the BOE, the PBOC. Any other letters in the alphabet? Well, any of these banks, central banks, can decide to print up money how they wish, as much as they want, and that will eventually slosh around and make its way into different markets around the world. It doesn't need to be the Federal Reserve. The Federal Reserve stopped printing, at least in the public eye, many years ago, and they've just kept their balance sheet at that same ridiculous approximately $4.5 trillion level. So they kept it there for years, and then they started to slowly diminish the amount that they held. And it's still going on today, and you can see that in the middle chart. But it's taken a long time, and it will take many, many years in order to get this off their balance sheet. However, just the minuscule amount that has been removed from their balance sheet has created a dramatic effect on equities globally, as well as other assets like real estate. And that, of course, is tied in to interest rates. There's a lot going on here. Obviously, it's not just one factor, but this is the most important, in my opinion. The global quantitative tightening policy that has taken place that will escalate in 2019 is a major concern. Oil glut, WTI future spread suggests bearish market over the next 6 months. So we'll talk about this very briefly. Basically, what I see with oil is a big problem because of the price that it is currently is unsustainable according to their silly statistics that they put out. Is it a glut today? Is it a shortage tomorrow? Nobody seems to know, and the price fluctuates wildly. How can these prices be maintained when we have so much controversy going on every day? One day you hear a report that the US is energy independent. The next day we hear that there's so much oil coming out of the US that it's going to punish the market. There's a glut just from the United States itself. Then the next day, a report comes out and suggests that Canadian crude oil is so cheap you can't even sell it anymore. The next day, we hear a report that Canadian crude is so expensive you can't sell it anymore. Then you have the possibility of the Strait of Hormuz being blocked, and that could send oil prices up to $200 a barrel. Then you have issues going on with Saudi and Turkey and the United States involved as a third party, and that right there, the tensions could escalate prices of oil to $100 a barrel. Then you have the issues that new forms of energy are coming out every day, and then it's going to take over the oil market and we no longer need it, and the usage is declining. And so this also is a huge factor. And it every day seems like we've encountered new information here that's going to put out the other information, and it's very wild, very inconsistent, and there's no way to price these commodities accurately. That's why you see this very important commodity, oil, being highly volatile on a daily basis. So this chart here is basically just suggesting that these oil futures, the spread suggests a bearish market over the next 6 months, and we're going to see how that goes, because the prices that we've seen with oil have been very subdued in the last little while because of everything that's occurring within the economy. We're being told there's a glut, but again, I don't want to repeat what I just said, but this has really taken a hit throughout 2018. There's no doubt about that. I went on a little bit of a rant, but I hope that was appreciated. Disappointing decade. Emerging market equities have underperformed global peers since 2010. MSCI Emerging Market Index spread over the MSCI All World Index. And what you're looking at is 10 years of disappointment. So that's happening to be the one sector or the one index looking at the emerging markets but it's showing us what has happened throughout 2018, which is what I really want to highlight, and it's looking weak going into 2019. There's been a few individuals who have suggested that because emerging markets have done so poorly in 2018 compared to the US counterparts, that it would be a wise idea to look at emerging markets. And I'm not suggesting either way. I just think that individuals have to stop necessarily looking for opportunities to buy, and they have to start looking for opportunities to protect themselves. The China effect. Emerging market stock index has been flat since Chinese growth slowed to single digits. All right. These charts, by the way, have been from Bloomberg. But what you're seeing here is the MSCI Emerging Market Index. That's the orange line. Basically flat for the last 10 years. They haven't been able to grow out of that. Haven't been able to achieve a higher level than they did in 2007, 2008 timeframe. And I don't even think this factors in inflation. I think we're just talking about specifically nominal levels. And look at the China GDP year over year. It's been slowly but surely declining. And I believe that it is pointing out that it's a 6.5% growth year over year. Obviously, much better than United States, Canada, Europe, Japan, so many different countries. Looking at that tells us, wow, such great growth, right? But look at where it was. Look at how it peaked out in what looks to be 2007, and it's essentially been declining ever since. Several years of declining, year after year after year. And this is using their fake, modified, and manipulated GDP statistics. Whereas you can see the other estimates, which have been provided, that show it to be approximately half of the level that they show us. I've seen reports of anywhere between 3 and 4% GDP growth when they were reporting over 7% GDP growth. So it must be more towards 3% today. All right, moving on very quickly. To finish the video off, I showed you at the beginning what 2017 reports would look like through 2018. And this, to finish the video off, is very telling. You might know Northman Trader, but he had this to say, and I totally agree with it. Investors take note. Wall Street explained. Upgrades near the top, downgrades 25% lower. We're looking at Apple. When it's at the absolute peak, everybody's upgrading the stock. The same thing with Amazon. At the absolute top of the peak, it hits $1 trillion. And there was an actual analyst with literally quoted, buy, buy, buy. And it didn't stay there for basically one trading session. That's it. They tell you at the very top, buy, 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 and then it drops into a bear market, and then they start to downgrade it. They're always too far behind. But people, time and time again, are getting swindled into thinking that this is the right time to buy. And I'm not telling you buy or don't buy. I'm not saying that. I'm saying don't look at these investment analysts. Don't look at all of the individuals on television, all the websites out there. Seeking Alpha told me this. Jim Cramer told me that. CNBC said this. Ray Dalio said that there's not going to be a crash until 2020. I've got lots of time and all this business. Stop with that. Have your own ideas in your own mind. Be prepared for yourself and make sure that you hedge your bets, for goodness sakes. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. That's all you got to do is click the one button, click the like button. I noticed more people are doing so today, and I hope that you will join all the rest every time. If you could click that button to support the channel, it's very easy, it doesn't cost a thing, so help me out with that if you can. And last but not least, if you want the financial education you were not taught in school, these two books have it all. You can get everything you need to in 2 books, very easy to read, very easy explanations from the foundation, your history, your money making, self-sufficiency, a lot covered between these 2 books. Check them out at the link in the description. And if you want the audiobook, you can get that at themoneygps.com.